Global debt is usually discussed like a number on a screen, a total, a warning, a countdown. But debt is not a single thing. It is a system, built over centuries, designed to keep running, even when it looks like it should stop. A system that can expand, roll over, refinance, reprice, and repackage itself until the original end date becomes a moving horizon. That is why this story matters. Because global debt is not simply a pile of obligations waiting to be paid off. It is the architecture of modern power. It funds governments, corporations, wars, housing booms, pensions, infrastructure, and the everyday liquidity that keeps trade alive. And it has one defining feature. It never really closes. Not because nobody pays anything back, but because the system is structured so that repayment often means replacement. Old debt is settled with new debt. Maturity is not an ending. It's a doorway to the next contract. To understand how we got here, you have to stop thinking about debt as personal finance and start thinking about it as political economy. Debt began as trust and then became leverage. In the ancient world, debt was local. It lived inside small networks of merchants, farmers, and rulers. It was recorded on tablets, enforced by social pressure, and often settled through land, labor, or tribute. The creditor and the debtor usually knew each other, or at least lived under the same authority. But the moment debt becomes transferable, it changes everything. Once an IOU can be sold, assigned, securitized, and enforced by an institution rather than a relationship, debt becomes a market instrument. It stops being a private promise and becomes a financial product. That shift over time creates the foundations of global debt. The modern story starts when states learn a revolutionary lesson. You can borrow more than you can tax, as long as people believe you will survive. Early modern governments faced a recurring problem: war. War demanded money quickly. Taxes were slow, political consent was limited. So states built credit systems. In the Dutch Republic and later in Britain, a new model emerged. The state could issue long-term debt, backed by reliable taxation and institutional credibility. Over time, Britain perfected a machine: a central bank, a bond market, and a tax system capable of servicing debt. This created something that looked paradoxical. A country could be heavily indebted and still be powerful, if its debt was trusted. Trust was the real currency. Debt became a way to pull future revenue into the present, turning the state into a time machine. It could fight wars today using income it had not yet collected. But there was a cost. Once borrowing becomes normal, governments build budgets around interest payments. They begin to treat refinancing as routine, and a market forms that depends on the debt continuing to exist. A strange equilibrium appears. The creditor wants stability, the state wants flexibility, and the system wants continuity. The closing of the debt becomes optional, sometimes even undesirable. Then the industrial age multiplies the scale. As economies industrialize, the demand for capital explodes. Railroads, factories, ports, urban housing, electrical grids, steel production. Modern corporations require large upfront investment, and debt becomes the preferred tool. Why debt? Because equity dilutes ownership, while debt preserves control. Debt allows industrial expansion while keeping the commanding heights, assets, voting rights, direction, inside a smaller circle. So a pattern forms. Leverage fuels growth, and growth justifies more leverage. But global debt is not only private. The state is always present. Governments issue debt to build infrastructure and manage crises. Banks grow large by holding government securities. Corporations grow large by borrowing from banks. Households grow dependent on mortgages, and the entire system begins to orbit interest rates, credit conditions, and confidence. Credit becomes the bloodstream. Then comes the shock that rewrites the 20th century: the Great War. World War I forces governments to borrow at unprecedented levels. The old monetary discipline, gold convertibility, fixed exchange rules, becomes impossible to maintain under total war. States suspend constraints, borrow massively, and use central banks more directly. After the war, They attempt to return to pre-war norms. But the reality has changed. Debt burdens are heavy. Reparations and political turmoil destabilize currencies. Some countries inflate. Others default. Some try austerity and collapse anyway. What looks like a debt problem becomes a legitimacy problem. Then the Great Depression arrives and the world learns another lesson. In a severe downturn, debt is not just an obligation, it is a drag on the entire economy. When incomes fall, but debts remain fixed, the real burden increases. Defaults rise, banks fail, credit contracts, and the economy can spiral downward. Governments respond by building new toolkits: deposit insurance, central bank backstops, fiscal stimulus, and regulatory control. This is when the state becomes a permanent manager of the credit cycle. Then comes World War II, and the system is rebuilt again. After 1945, leaders try to design a world where debt does not collapse into chaos. They build institutions, they formalize rules, they create a new global monetary order. This is where Bretton Woods enters the story. Under Bretton Woods, currencies are tied to the US dollar, and the dollar is tied indirectly to gold. The United States becomes the anchor of global liquidity. Trade expands, reconstruction accelerates, and global finance begins to integrate. But the system contains a tension that will eventually break it. To supply the world with dollars for trade and reserves, the US must run deficits or export capital. The world needs the currency. The currency requires issuance. So global stability depends on a country creating liabilities that foreigners will hold. That is not just economics. It is geopolitics. As the decades progress, the supply of dollars grows. U.S. obligations expand. The gold link becomes increasingly strained. And in 1971, the convertibility of dollars to gold is effectively ended. The world moves into a new era: fiat money, floating exchange rates, and a debt system that can expand without a hard metallic ceiling. This is where the system that never closes truly takes shape. Because when money is fiat, the limit is no longer gold. The limit becomes confidence, inflation, and political stability. And the next transformation is subtle, but decisive: the rise of the offshore dollar system. Dollars begin circulating outside the United States through international banks, the Eurodollar market. Corporations borrow in dollars. Countries trade in dollars. Banks create dollar-denominated credit outside U.S. borders. The dollar becomes less a national currency and more a global operating system. This is crucial for global debt, because a global reserve currency allows massive borrowing across borders. It lubricates trade, investment, and leverage. It makes global finance faster, deeper, and more interconnected. But it also creates vulnerability. When the dollar system tightens, stress spreads everywhere. Now add another layer: sovereign debt in emerging markets. When global liquidity is abundant, investors search for yield. Funds flow into developing countries. Loans are often denominated in foreign currency. Growth accelerates. But when conditions change, when U.S. rates rise, when the dollar strengthens, when commodity prices fall, the burden becomes crushing. A country that earns mostly in its local currency now has to repay in dollars. That mismatch can turn into crisis overnight. The 1980s debt crises in Latin America, the 1997 Asian financial crisis, Russia 1998, Argentina multiple times. These are not isolated stories. They are recurring episodes of the same mechanism: external debt meets currency constraint. It is the global debt system revealing its hierarchy. Some borrowers can always refinance, others must beg for rollover. Others are forced into restructuring under pressure. And this is where the IMF and international rescue structures become part of the system's logic. They are presented as emergency support. Sometimes they are. But they also function as a bridge, a way to keep the debt machine from snapping, by moving obligations, extending maturities, imposing conditions, and restoring the minimum confidence needed for lenders to return. This is not a moral story. It is a structural story. The system is designed to prevent closure through collapse. Then comes the 21st century, and global debt accelerates into a new regime. The world experiences repeated shocks: the dot-com bust, 2008, the Eurozone crisis, the pandemic, energy disruptions. Each time, policymakers reach for the same central tools: lower rates, inject liquidity, expand balance sheets, stabilize banks, support fiscal spending. In practical terms, the response to crisis becomes a pattern: socialize the downside to preserve the system. 2008 is a turning point. The global financial crisis begins as a private credit boom: housing, leverage, securitization, short-term funding, then turns into a systemic banking panic. When banks and shadow banks freeze, the state steps in. Central banks become lenders of last resort at scale. Governments guarantee liabilities. Bailouts and emergency facilities keep the core from collapsing. And after the dust settles, something becomes clear. Debt did not disappear. It moved. Private losses were absorbed into public balance sheets, central bank balance sheets, or hidden through restructuring and slow deleveraging. The debt system survives by shifting where the burden sits. That is one reason it never closes. Then the Eurozone crisis reveals another layer: the difference between a country that issues debt in a currency it controls and a country that borrows in a currency it cannot print. In the Eurozone, member states use a shared currency but do not individually control the central bank. They resemble emerging markets in one key sense: they can face a liquidity crisis that becomes a solvency crisis. If investors panic, yields rise. Refinancing becomes impossible. The system threatens to break, and the resolution requires a new guarantee, a central bank commitment strong enough to stop the run. This is another never-closes mechanism: credibility as a backstop. If markets believe the backstop is real, the crisis can end without the backstop being fully used. Confidence does the heavy lifting. Then the pandemic arrives, and global debt goes vertical. Governments spend to prevent depression. Central banks purchase assets to stabilize markets. Deficits expand. Corporate borrowing rises. Household borrowing continues in many places because rates are low and housing remains a primary asset. Debt becomes the policy response, not as ideology, but as triage. And this leads to the central paradox of modern debt. Debt is the tool used to postpone closure. When growth is strong and borrowing costs are low, debt is manageable. When rates rise or growth stalls, debt becomes heavy. But instead of shutting down, the system evolves. Maturities are extended. Inflation quietly reduces real burdens. Regulations push institutions to hold safe assets, and central banks provide liquidity during stress. The system keeps moving. So why does it never close? Because closure is politically and economically costly. If the global debt stock were rapidly paid down, you would need either massive surpluses, higher taxes and lower spending, or large-scale defaults and bankruptcies. Both are painful. Both produce political instability. Both can trigger financial crises. In many cases, the choice becomes slow erosion versus violent reset. And modern systems tend to choose slow erosion. This is where inflation returns as a quiet character in the story. Inflation is not merely rising prices. In a debt system, inflation is a form of redistribution. It reduces the real value of fixed-rate debt over time. It transfers purchasing power from creditors to debtors, especially when nominal interest rates are held below inflation. That is why periods after major debt buildups often involve some combination of moderate inflation, controlled interest rates, financial repression, gradual restructuring, and growth, if growth can be sustained. This is not conspiracy. It is arithmetic. If a society accumulates debt faster than it can generate future income, it must eventually adjust. The adjustment can happen through repayment, default, or devaluation. And devaluation is often the least visibly explosive option. Now consider the role of the banking system. Banks do not simply lend out deposits in the simplistic sense. Modern banking creates credit. When a bank issues a loan, it creates a deposit, new money, inside the system. That money circulates until it is repaid, defaulted, or rolled. This means debt and money are linked. In a credit-based economy, much of the money supply is created through lending. Paying down debt can shrink money, slow the economy, and trigger recession. So policymakers face a dilemma. Deleveraging can stabilize long-term balance sheets, but it can also break short-term activity. That is why the system resists closure. Closure can look like collapse. Another reason is institutional. Pension funds, insurers, banks, and sovereign wealth funds depend on large pools of safe assets. Government bonds are not only debt, they are collateral, benchmarks, and the foundation of modern finance. They are used in repurchase agreements, derivatives margins, regulatory capital frameworks, and liquidity management. In other words, government debt is part of the infrastructure. Remove it suddenly, and the system loses a key stabilizer. So the debt remains and grows because the system is built around it. Then there is politics. Debt is how governments promise more than they can collect today. It is how they avoid raising taxes in the present. It is how they fund projects without immediate sacrifice. It is how they manage crises without asking the public for an upfront bill. Debt is the political technology of postponement, and that postponement becomes habit. But postponement has a price: interest. If interest rates are low, the price is manageable. If rates rise, the price becomes visible. Budgets tighten, trade-offs harden, tensions rise between spending priorities. This is where the global debt story is heading in many regions. A world where debt service competes with everything else: health, education, infrastructure, defense, pensions. The system doesn't close, it strains. And when it strains, it reaches for new methods. Sometimes those methods are financial engineering. Longer maturities, inflation-linked structures, new bond programs, new buyer bases. Sometimes those methods are political: austerity, taxation, wealth transfers, policy reform. Sometimes those methods are outright restructuring: haircuts, maturity extensions, negotiated defaults. But even restructuring is rarely a closing. It is a restart. Old promises are rewritten into new promises. That is the deeper truth. Global debt is not designed to end. It is designed to roll. So what keeps it from rolling forever? 3 things. First, inflation that gets out of control and breaks trust. Second, political fracture that breaks institutions. Third, real economic stagnation that makes the future too small to carry the past. Those are the true constraints, not a moral argument about debt being bad, but the conditions under which rollover stops being credible. When trust breaks, lenders demand higher rates, shorten maturities, or refuse funding. When institutions break, contracts become uncertain. When growth collapses, the future income needed to service debt disappears. And this is where history becomes practical, because every era has its version of the same moment. The realization that the future is not infinite. In the short term, debt feels like oxygen. In the long term, it can become gravity. So when you hear that global debt is unsustainable, the real question is not whether the number is large. The question is, sustainable under what conditions? Under low rates and stable growth, high debt can persist for decades. Under high rates and weak growth, even moderate debt can become dangerous. And under political instability, any debt can become unfinanceable. That is why the global debt system looks immortal, until it doesn't. It is a machine that runs on confidence, and confidence is a social asset, a fragile one. The true history of global debt is not a straight line. It is a repeating cycle. Crisis creates borrowing. Borrowing creates growth, or the illusion of it. Growth encourages more leverage. Leverage creates fragility. Fragility creates crisis again. And each cycle adds layers, new institutions, new instruments, new rules, to prevent the final closure. So the system never closes in a clean way. It either rolls forward, or it resets under stress. And the most important insight is this: global debt is not merely the result of irresponsible choices. It is the product of a world built on credit, where governments, corporations, and households are structurally incentivized to borrow, because borrowing is how modern systems move value through time. That is why the story is not pay it all off. The story is manage the machine without breaking trust. Because when trust breaks, debt stops being a system and becomes a crisis. And that is the moment the world remembers what debt really is, a promise about the future, a promise that only holds as long as people believe the future will arrive in a form that can honor it.